Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 148, and in this episode, we're reviewing the performance of the global markets during the 8th week of 2025, and that is from Monday the 17th to Friday the 21st of February. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off in the United Kingdom, where according to data released by the Office for National Statistics, inflation in the United Kingdom rose sharply to 3% in the month of January, coming in above economists' expectations for a reading of 2.8% and well above the inflation rate for December 2024, which came in much lower than expected at 2.5%. Core inflation, which excludes volatile food and energy prices, rose by 3.7% in the 12 months to January, compared to 3.2% in December, and marked the highest rate since April 2024. The rate of inflation in the UK had hit a 3-year low of 1.7% in September 2024, but monthly prices have picked up since then, mainly on the back of higher fuel costs. Earlier this month, sluggish economic growth and a recent drop in inflation prompted the Bank of England to effect its first interest rate cut of 2025, bringing its policy rate down to 4.5%. The central bank signaled further rate cuts were in the pipeline, but noted that higher energy costs and regulated price changes are expected to push headline inflation to 3.7% in the third quarter of 2025. Over to the land of the rising sun, where the annual rate of inflation in Japan shot up to 4% in the month of January, hitting its highest level since January 2023, and further strengthening the case for rate hikes by the Bank of Japan. The core inflation rate, which excludes the price of fresh food, rose to 3.2%, up from 3% in December, and beat economists' expectations for a reading of 3.1%, and was the highest rate since June 2023. Meanwhile, the so-called core inflation, which strips out both fresh food and energy prices and is closely monitored by the Bank of Japan, climbed slightly by just 0.1% to 2.5%. The headline rate of inflation, which came in at 3.6% in December and is now at 4% in January, has remained above the Bank of Japan's target rate of 2% for 34 consecutive months. This latest inflation report has boosted the case for the Bank of Japan to hike interest rates as the risk for further inflation and weakness in the Japanese yen continues to persist. The governor for the Bank of Japan, Kazuo Ueda, said on Friday that the central bank stands ready to increase the government bond buying program if yields continue to rise sharply. On Wall Street this past week, the latest economic data sparked a stock sell-off on Friday, with investors concerned about a slowdown in the U.S. economy, accompanied by sticky inflation, a condition referred to as stagflation, which has led most investors in search for safer investment assets. Losses intensified on Friday as traders unwound their long positions ahead of the weekend on increased uncertainty about what to expect from the Trump administration, given the recent flurry of trade tariffs and other market-moving policy changes. A volley of data reports raised concerns about the state of the U.S. economy and sent investors into bonds, which caused their yields to tumble. The University of Michigan Consumer Sentiment Index fell by 10% to 64.7 in February as consumers raised concerns about tariffs and higher inflation. Friday saw the largest decline so far this year for the Dow Jones Industrial Average as it lost 748 points and was down by about 2.5% for the week to close at 43,428. Meanwhile, the S&P 500 slid by about 1.7% during the week to end the session at 6,013. And the tech-heavy Nasdaq Composite dropped by about 2.5% to eventually settle at 19,524. In the U.S. Treasury bond market, U.S. Treasury yields were sharply lower on Friday, and conversely, bond prices were much higher. And this was on the back of a stock market sell-off that was sparked by concerns over the health of the U.S. economy that saw investors dump stocks for the safety of U.S. government bonds. The University of Michigan's Consumer Sentiment Index fell more than expected in February as consumers raised concerns about tariffs and higher inflation. Friday's drop in yields came alongside a steep sell-off in equities following the release of a fresh round of economic data that indicates the U.S. economy is slowing down, and this weighed down on the stock market and caused Treasury yields to flatten across the yield curve. The yield on the benchmark 10-year Treasury bond dropped by about 7 basis points to close out at 4.42%, whilst the yield on the policy-sensitive 2-year Treasury note was lower by more than 6 basis points to settle at 4.20%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as yields rise, bond prices fall, and vice versa. In the energy markets, the price of crude oil fell more than $2 a barrel on Friday and ended up posting a weekly decline as investors grappled with a fading premium for Middle East risk alongside uncertainty about a potential peace deal between Russia and Ukraine. The relative calm in the Middle East as the Gaza ceasefire continues to hold is what has led to a reduction in the risk premium for crude oil as geopolitical tensions abate with the ongoing release of hostages. Meanwhile, the flow of crude oil through the Caspian pipeline was reduced by about 30 to 40% on Tuesday following a drone attack by Ukraine on one of the pumping stations. On the demand front, analysts at JP Morgan expect cold weather in the United States and an increase in industrial activity in China to contribute more demand in the coming weeks. For the week, the global benchmark Brent crude was down by 0.4% to settle at $74.43 a barrel, whilst the price of the US benchmark, that is West Texas Intermediate crude, posted a weekly loss of 0.5% to close at $70.40 per barrel. In the precious metals market, the price of gold took a dip on Friday as investors booked profits from the previous session's record high, but nevertheless, gold was still on track for its 8th consecutive week of gains, driven mainly by strong safe haven demand amid concerns about President Trump's trade tariffs and uncertainties surrounding global economic growth. The price of bullion has risen about 11% so far this year, and this past week it broke above two record highs to trade above $2,950 per ounce. The fundamentals for gold remain solid, and the price of spot gold gained about 1.7% this past week after rising to a record high of $2,954 per ounce. In the cryptocurrency market, Bybit, which is a major cryptocurrency exchange, has been hacked to the tune of $1.5 billion in digital assets in what is estimated to be the largest crypto heist in history. The hackers infiltrated Bybit's multi-signature cold wallet for Ethereum and drained out about $1.5 billion in crypto. For your information, the multi-signature cold wallet is an offline storage system that is designated for additional security. Companies use multi-signature wallets in order to mitigate against a single point of failure, as multiple signers are required to approve a transaction. However, in this particular case, the hackers managed to deceive all the signers. The stolen crypto, which was primarily in Ether, was quickly transferred across multiple wallets and liquidated through various platforms. The attack, which occurred on Friday the 21st of February, may be the largest ever hack against a single crypto exchange and accounts for about 50% of the total crypto that was siphoned in 2024. This story highlights the significant risks associated with cryptocurrencies, which is why it's advisable that crypto investors transfer their assets from the exchange into your own personal cold storage wallet, and secondly, that you only invest a small percentage, say less than 5% of your total portfolio in crypto. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenyan shilling depreciated marginally versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.45 compared to 129.21 that was recorded the previous week. Meanwhile, the sterling pound was priced at 163.06 and the euro was valued at 135.03. And on the regional front, one Kenyan shilling was changing hands for 28.37 Ugandan shillings and 20.12 Tanzanian shillings. And to the Rwandese franc, it was posted at 10.79. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves recorded a significant decline of $118 million for a grand total of $9.256 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that the central bank does not provide any explanation for the change in foreign exchange reserves. However, in the spirit of transparency, I have written to the central bank requesting them to provide more information on the change in foreign exchange reserves, especially when there is a significant change of more than $50 million. However, so far there has been no response from the central bank, but I will continue to keep you posted on the progress. In the money markets, the interbank market was sufficiently well funded, and this was mainly due to the recent reduction in the cash reserve ratio and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased marginally by 18 basis points from 10.50% the previous week up to 10.68%. And in terms of volume, the average value that was traded in the interbank market, this increased to 22.7 billion shillings, up from 14.4 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the new cash reserve ratio of 3.25%, this stood at 26.5 billion shillings. For your information, the cash ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 20th of February, and the central bank received bids totaling to 32.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 137%. That said, the results of the auction were as follows. The 91-day rate dipped by 2 basis points to average out at 8.94%, whilst the 182-day rate declined by about 10 basis points to level off at 9.31%, and the 364-day rate slipped by about 7 basis points to settle at 10.52%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the March bond issue and is looking to raise a total of 25 billion shillings through the sale of a reopened 25-year Treasury bond whose terms and conditions are as follows. The bond reference number is FXD1/2018/25 with 18.3 years left to maturity and a coupon rate at 13.4%. This bond is now open for sale until Wednesday, the 5th of March, 2025. On the Treasury bond buyback, the Central Bank of Kenya was looking to buy back a total of 50 billion shillings and had targeted 3 specific bonds that are due to mature in the next 2 months with the aim of reducing the value of maturities, given that these 3 bonds have a total outstanding value of about 185 billion shillings. The offer for the buyback closed on Monday, the 17th of February, and the central bank received bids amounting to 56 billion shillings, but ended up redeeming slightly above its target at 50.08 billion shillings. At the Nairobi Securities Exchange, the equities market was on an upward trajectory, with the NASI gaining the most by 1.3%, whilst the NSE 20, the NSE 10, and the NSE 25 gained by 0.8%, 0.5%, and 0.3% respectively. This takes a year-to-date performance to gains of 8.9% for the NSE 20, 6% flat for the NASI, 3.2% for the NSE 25, and 2.5% for the NSE 10. The market's performance was driven by gains recorded by large-cap stocks such as DTB Bank, Safaricom, and Cooperative Bank, whose shares increased in value by 4% flat, 3.9%, and 3% flat, respectively. These gains were, however, weighed down by losses recorded by other large-cap stocks such as Kenya Commercial Bank, East African Breweries, and Equity Bank, whose shares declined by 2.8%, 1.9%, and 1.4%, respectively. Up next is our topical issue, and this week we're looking at the transmission of the central bank rate. The interbank market, where banks extend loans to one another on an overnight basis, has seen interest rates drop to their lowest level in more than 14 months, and this is mainly attributed to the recent reduction in the central bank rate. Earlier this month, the central bank cut its benchmark lending rate by 50 basis points from 11.25% down to 10.75%, and in response, the interbank rate has fallen to as low as 10.49% this past week, which was its lowest level since December 2023. Since the adoption of a monetary policy implementation framework, which sought to enhance the transmission of the central bank's monetary policy, it has been observed that the interbank rate now closely tracks the central bank rate. The monetary policy framework, which is based on inflation targeting, established an interest rate corridor of 150 basis points above and below the central bank rate. This implies that the interbank rate must never exceed or fall below the central bank rate by more than 1.5 percentage points. You may also recall that the Monetary Policy Committee not only reduced the central bank rate to 10.75%, but also reduced the cash reserve ratio by 1 percentage point to 3.25%. This two-pronged approach was aimed at reducing the cost of borrowing as well as injecting additional liquidity into the interbank market, which would ultimately support the growth of credit to the private sector. And to ensure that banks are transmitting this reduction in interest rates to their customers, the central bank has embarked on an on-site inspection of banks to ascertain that they are reducing their interest rates in line with the reduction in the central bank rate. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please consider supporting this podcast by becoming an active subscriber. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. And in this regard, I would like to send a special shout out to our first two active subscribers, that is Stella Mungai and Evans Kindiga, and to say thank you for your continued support. And just for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, make way for life. And I repeat, make way for life. Think about it. Thank you, and God bless.